What if the smallest number on your credit card statement is actually the most dangerous number? Not because it is illegal, not because it is hidden, but because it feels responsible. Every month, millions of Canadians open a credit card statement and see something like this. Balance, $5,000. Minimum payment, $150. And your brain says, okay, I can handle $150. That's where the trap begins. Because the minimum payment is not designed to get you out of debt quickly. It is designed to keep the account alive. And those two things are very, very different. Most people do not fall into debt because they are reckless. They fall into debt because the system gives them a payment that feels small enough to survive this month. But here's the part nobody explains clearly. Surviving the month is not the same as escaping the debt. Imagine this. You're already dealing with rent or a mortgage, groceries, car insurance, hydro, phone bills, maybe daycare, maybe student loans, maybe sending money to family. Then the credit card bill comes. You don't have $5,000 sitting around, so you pay the minimum.
And honestly, it feels like a relief. The account is not overdue. The bank is not calling. Your credit score is not immediately on fire. You did the thing you were supposed to do. But quietly, in the background, interest is still working, and interest does not care that you are tired. This is what I call the minimum payment effect. It is the feeling that you are making progress because you made a payment, when in reality, a big part of that payment may be going toward interest, not toward actually reducing the debt. And if you have ever felt like, I keep paying this card, but the balance barely moves, this video is for you. Now, quick disclaimer before we get into the math. This video is for general educational information only. It is not personal financial, legal, or debt advice. Everyone's situation is different, and if you are overwhelmed by debt, it may be worth speaking with a qualified professional or a nonprofit credit counselor. Okay, let's make this simple. Let's say a Canadian has a credit card balance of $5,000. The interest rate is around 20%. The minimum payment is $150.
At first, $150 feels manageable. It is not fun, but it feels doable. But here is the problem. If the card is charging interest, part of that $150 is not reducing the original $5,000. Part of it is just paying the cost of carrying the debt. So you send the bank $150, but your balance might not drop by $150. It might drop by much less. And this is where the math starts to feel unfair, because you think you are pushing the debt down, but interest is pushing it back up. It's like trying to walk down an escalator that is moving upward. You are moving, you are making effort, you are doing something, but you are not getting down as fast as you think. And for many people, this creates one of the most stressful feelings in personal finance. I am paying every month, so why am I still stuck? Here is the hidden mechanism. A minimum payment is basically the lender saying, pay at least this much so your account stays in good standing. That's useful if you're in a tight month, but it's not the same as saying, pay this amount and you will become debt-free quickly. Those are completely different messages.
And this is the part that traps people emotionally. The minimum payment gives you a short-term feeling of control, but it can create a long-term feeling of being trapped. Because next month, the statement comes again, and the balance is still large. Then, life happens. Your car needs repairs. Groceries are higher than expected. Your rent goes up. A family event comes up. Winter tires show up like a seasonal tax on being Canadian. So you use the card again. Not because you're trying to be irresponsible, but because the gap between income and expenses is too tight. Now the $5,000 becomes $5,300, then $5,800. Then one day you look at the statement and think, how did it get this bad? But it did not happen in one big dramatic moment. It happened quietly, one minimum payment at a time. And that is why this trap is so powerful. It does not feel like a trap while you're inside it. It feels like maintenance. It feels like keeping your head above water.
But here is the uncomfortable truth. Minimum payments can turn debt into a monthly subscription. Except instead of subscribing to Netflix, you are subscribing to yesterday's groceries, last year's emergency, or a purchase you barely remember. And the subscription renews every month. Now, let's talk about why banks and lenders are perfectly fine with this minimum payment. A lender does not need you to pay off the balance quickly to make money. In many cases, they make more money when the debt stays around longer. That does not mean every credit card is evil. Credit cards can be useful tools when used carefully. They can help with convenience, fraud protection, online purchases, and sometimes rewards. But when you carry a balance, the relationship changes. The card stops being a payment tool. It becomes a very expensive loan. And that is the shift many people miss. A credit card feels like money access, but when you carry the balance, it becomes debt access. And those two things feel similar in the moment, but completely different later. Here's another hook most people do not think about. The minimum payment doesn't just cost money, it costs options. Because every dollar going to debt interest is a dollar that cannot go somewhere else. It cannot go to your emergency fund. It cannot go to your TFSA. It cannot go to your RRSP. It cannot go to your child's RESP. It cannot go to saving for a home. It cannot go to finally having breathing room. This is why debt feels heavier than the number on the screen. A $5,000 balance is not just $5,000. It is the stress of checking your account, the guilt when you tap the card again, the frustration of payday disappearing, the feeling that you are working hard but not moving forward. And if you have ever avoided opening your banking app because you already knew it would make you feel bad, you're not alone. That is part of the minimum payment effect too. The payment is small enough to avoid panic, but the balance is big enough to create shame. And shame makes people avoid the problem. Then avoidance lets the problem grow. That is the debt loop. Stress, avoidance, minimum payment, temporary relief, interest, bigger stress, and then repeat. Now, here's where many videos make a mistake. They say, just stop spending. But that advice is too simple, because many Canadians are not using credit cards to buy yachts and gold-plated maple syrup. They're using them because life got expensive. Groceries are higher, rent is higher, insurance is higher, mortgage payments may have jumped, and wages do not always move fast enough to keep up. So this is not about blaming people. This is about understanding the machine. Because once you understand the machine, you can stop mistaking a minimum payment for a solution. So what can you do instead? Step 1. Find the real numbers. Not the emotional numbers, not the numbers you think are probably close, the actual numbers. Write down each debt: credit card, line of credit, car loan, buy now, pay later balance, overdraft, anything you owe. For each one, write 3 things: how much you owe, the minimum payment, the interest rate. That last one matters more than people think, because a $2,000 balance at a high interest rate may be more urgent than a bigger debt at a much lower rate. This is where the fog starts to clear. Debt feels scarier when it is vague. It becomes more manageable when it is visible. Step 2. Stop treating all debt as emotionally equal. Some debt is expensive. Some debt is less expensive. Some debt is dangerous because the payment is tiny, but the interest rate is brutal. For many people, high-interest debt deserves attention first because it grows faster. This does not mean everyone has the same perfect strategy. Some people prefer the debt avalanche method, where they focus on the highest interest rate first. Others prefer the debt snowball method, where they pay off the smallest balance first to build momentum. The best method is usually the one you can actually stick with. But here is the key. You need a plan that pays more than the minimum somewhere, because if every debt only gets the minimum forever, the system stays in control. Step 3. Protect yourself from adding new debt while paying old debt. This is the part people skip. They make a plan to pay down the credit card, but they still have no emergency buffer.
Then one surprise bill appears, and the card gets used again, so the balance goes down, then back up, down, then back up. And that can feel like failure. But often it is not failure, it is a missing buffer. Even a small emergency fund can help reduce the need to keep going back to the card. It does not have to be perfect, it just has to create a little bit of space between life and the credit limit. Because when your credit card is your emergency fund, every emergency becomes more expensive. That line is worth remembering. When your credit card is your emergency fund, every emergency becomes more expensive.
Step 4. Watch the available credit illusion. This one is sneaky. Your card might say you have $2,000 available, but available credit is not available money. It is available debt. That sounds obvious, but emotionally it matters. Because when your checking account is low and your credit card still has room, your brain may treat that room like a backup plan. But it is not a backup plan. It is borrowing from future you. And future you already has rent, groceries, insurance, taxes, and everything else waiting. So every time you borrow from future you, you make next month tighter. And when next month gets tighter, the minimum payment starts looking attractive again. That is how the loop rebuilds itself. Step 5. Do not ignore help if the numbers are becoming unmanageable. There's a difference between a tight month and a debt situation that is starting to control your life. If you're using one credit card to pay another, if you're regularly missing payments, if you're borrowing just to cover minimums, if you're afraid to answer calls from lenders, that is not just a budgeting issue. That may be a sign to talk to a qualified professional or a nonprofit credit counseling organization. There is no shame in getting help. The shame belongs to a system that makes debt easy to enter and hard to escape. Now let's bring this back to the main point. The minimum payment is not bad by itself. If money is tight, paying at least the minimum can help avoid worse consequences like missed payment problems. But the minimum payment should be treated like a warning light, not a strategy. It says, you kept the account alive this month. It does not say you are on track to become debt-free. That difference can change everything. So before you pay your next credit card bill, look at the statement differently. Do not just ask, what is the minimum payment? Ask, how much of this payment is actually reducing my balance? Ask, what interest rate am I paying? Ask, if I keep doing this for another year, will I be in a better place?
And most importantly, what small change could help me pay more than the minimum, even if it is not perfect? Because escaping debt does not usually start with one dramatic move. It starts when you stop letting the minimum payment define the plan. You can still use the minimum payment in a hard month, but do not let it become the whole strategy. Because the minimum payment is like paying rent to your past decisions, and the longer you keep paying rent to the past, the harder it is to build something for the future. So here's the simple takeaway. The minimum payment keeps the door open, but paying down the balance is what helps you walk out. And that's the difference most people are never taught. If this topic hit close to home, comment below. Have you ever felt like you were paying a credit card every month, but the balance barely moved? And if you want more simple Canadian money explainers like this, subscribe to New Canadian Wallet. Because the goal here is not to make money feel scary. It's to make the hidden traps easier to see before they quietly cost you more.